Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The goods and services tax has turned 6, and in the past few years, this single unified tax has radically altered the economic framework of India. The country is now a one nation, one tax, one market economy and joins some of the leading advanced economies across the world with similar indirect tax regimes. There are many wins and lots that remain work in progress. So what next after 6 years of the goods and services tax? What changes are required to make it even more efficient? Is there need to rationalize the rates and reduce compliance? Should exemptions also be cut? And most importantly, what is India Inc. saying? Joining me to answer these and more questions is Mahesh Jaising, partner and leader the indirect tax practice at Deloitte India. Welcome to the show, Mahesh. Lovely frame behind you, and I'm going to ask you to tell our viewers that in terms of age, would you call India's GST a baby, or is it a teenager, or is it a full-grown man or woman? How would you describe GST?
Well, it's certainly clear that it's no longer a baby, and it's certainly not an old dog. So you left me no choice but to call it a teenager. But I think that so that would be the first answer, and I'm excited that we're having this conversation right at the 6th anniversary of GST. Siddharth, thanks for having me over.
Wonderful. Let me begin by asking you to tell our viewers in the simplest format as possible, because GST, remember, was promised as a good and simple tax. 6 years, if we look back, is it indeed living up to the promise of being a good and simple tax?
So one is my view, the other is a survey that we've done of 612 participants, Siddharth, and this represents large, very large, and MSME companies as well. And MSME is 21% of the population of our respondents. Overall, a great thumbs up. 94% have welcomed GST. That's neutral plus the positives. And from that 94%, 72% have given a positive as against 59 of last year. So straight answer is that the business fraternity has clearly given it a thumbs up, and it's given a better thumbs up than last year. At the same time and at the same breath, there are very detailed and specific recommendations that the law is now well poised for certain ease of business doing changes that we'll talk about in the course of our discussion today. So a thumbs up with a lot of suggestions on things to come from our end. That's a balanced outcome of what we've seen from our respondents to our survey.
One of the interesting findings of your survey that you just mentioned is micro, small and medium enterprises. When GST started out, in the initial few months, in fact, perhaps for the first couple of years, we heard a lot of negative feedback from small firms, which, like you pointed out, constitute almost 1/4 of India's productive corporate engine. What has led to this kind of a response and finding in your survey?
I think very relatable for the initial apprehensions, because the apprehension of a new law, of a lot of data reporting. These were the two real apprehensions, if I were to put the two categories. On the law being new, the traders anyway were subject to VAT and subject to an output tax reporting on a real time and even claiming VAT credit. Soon, in no time, they started recognizing the benefit of there being no Form C and no interstate tax, and therefore no cascading effect of tax. So in some sense, the financial benefit and transparency of the rate of tax system started emerging. On the technology front, right in the beginning, there was a plan to have a e-reporting in a particular manner, GSTR 1, 2, 3. The government very quickly course-corrected that and gave a longer runway to have line-by-line reporting. Then came in the e-way bill technology reform, and then came the e-invoicing. So e-reporting, e-way bill, and e-invoicing, all of which over some period of time, and thanks to the ability to get enough and more trainings and updates on how to embrace this technology, the medium MSME sector has now started embracing GST and looking at the positives of having real-time credit reporting and things like that. So I think it's a journey, and I think even from the government standpoint, we started with 500 crores of e-invoicing in October 2020. We're sitting in June 2023, and now we'll be embarking on the 5 crore limit, Siddharth.
Okay. I also want you to later on talk about some of the consumer related aspects, but since your survey was of corporate respondents, I also want you to tell our viewers that what is that remains as work in progress and what corporate India would like to be fixed with GST, sort of the reforms that are required for GST.
So there are two set of recommendations that have come in from corporate India. One on the ease of doing business or the operational matters around audits, assessments, which I'll explain. And the other is on changes around the working capital and ITC credit. So let's start with what is more operational and very critical, because at the end of the day, GST is a transaction tax, and therefore every transaction needs to be, reported and compliance made. One of the things from the survey that came out was dual investigations and audits is an area of concern, probably the highest area of concern of industry. And let's not forget that it's a constitutional framework. States do have a right to do the assessments. I don't think anybody's questioning that. It's just that in each state, to address my queries to either the central officer or state officers, fine. But in the last few months, the experience has been in some cases there have been same SSE being reached out by both set of authorities. So that's the number one ask, saying that there be more standard operating procedures and an implementation which is a little bit more, exchanging of letters and getting data and specific assessment rather than calling upon, individuals to give statements and stuff like that. Second, the second most complicated part or concern area of the corporate India is increased efforts to meet audits and assessments. Now, to me, I can relate to that because we are in year six. You asked me, is it a child? Is it a teenager? Since 5 years has passed by and since the tax assessments have to happen by virtue of the period of limitation, it is but natural that the audits will increase. So I think the seatbelts have to be fastened a bit to deal with these audits. And therefore, while there are two areas, to me, the standout is the dual investigation, Siddharth. Coming to the policy side, I think clearly with the record collections that are right on the screen right now, the industry is hoping that there'll be some reforms which are not necessarily loss of revenue to the government per se, but can help get in more cash and more transfer, more benefit and clarity in the system of taxation. So three things that came. 78% participants said export liberalization, which says that make the export rules more simple to demonstrate because they keep getting questions, are you an export service or not, particularly in service, not the good side. Second is working capital unlocking. So businesses that are into infrastructure, have a logistics, telecom, they have a long gestation period when they get completely profitable. And therefore, many of these companies sit on a fair amount of tax credit. And their request is, let's go back to the pre-GST regime where my credit should be given back to me at the end of the year as a check once the audit is complete. Because the law today only allows refund for an exporter or an inverted duty structure player. And 67%, the third highest recommendation, is to remove some of the ITC credit restrictions like construction related, more automobile and personal related expenses of employees.
Okay. In terms of the headline rates, what was the finding from your survey, if that actually even got discussed?
It did. I think 30% participants are hoping for a more single rate structure, but practically and objectively, I wouldn't. And when I look at all the comments together, I don't think uh, there is an expectation of a tearing hurry to get a single rate. But what has emerged, because you also need to see the journey, we started with 28% being for almost 220 items. It's down to less than 30, 40 items. So the government has rationalized the rates. There is still merit to have better rationalization. A GOM for the rates was constituted last year. That is still work in progress, and we need to see what outcome comes in there. But an interesting aspect that emerged from the survey is that with the record collections, should we look at some of the growth sectors to get slightly lower rates? And even on the services side, today the services are either 18 or it's 12%. Isn't there merit to look at some services, whether fitness services, yoga services, certain medical services, which are otherwise taxed because otherwise medical services are largely exempt? But can we look at the 12% rate coming in for some services, Siddharth? So that's really the key takeaway from the survey. Because last year the rate rationalization was a much higher, percentage, and I think since a lot of inverted duty rate rationalization has happened and that journey's traveled, this year it's moderate, but there are still expectations in some pockets.
Two follow-up questions from what you just said. The first one really in terms of the higher revenue collections, and we have been playing that graphic on the screen as we speak. If we look at the collections, do you think there is scope, given the headline collection numbers, for both the states and the center to consider reductions in rates on specific items?
Yes and no. I think that there is scope for reduction in overall tax impact. I would use that phrase rather than only rates. To some extent, the rate rationalization is expected in some pockets. But the larger expectation is to get these few reforms, which I talked about, working capital, unlocking, giving the money back to companies so that they can deploy it in their businesses. Otherwise, a dead asset is as good as an expense rather than calling it an asset. And the other is certain ITC restrictions for growth sectors. Today, in a mall or a commercial complex or a logistics warehouse, there's so much cost incurred to set up that warehouse, which whatever is civil in nature, you don't get the credit. So the expectation is that the revenue buoyancy should at least result in some changes on the credit restriction as working capital. That seems to be standing out more than saying, let's reduce the rate of tax.
Wouldn't there be a possibility of tweaks in the tax rates and the tax incidence or impact, as you call it, given that we are now headed for the general election in around 11 months from now?
Well, I do think while there could be a review of rates overall, I'm not sure whether the general election should per se result in a significant directional change on the rate of tax or otherwise, because I think the journey has been traveled. The classification disputes by and large have been more moderate now, and I don't expect a very hastened decision on the rate of tax. And I'm banking on more the group of ministers coming out with a consensus-based approach on how to deal with recommendations on rate of tax, because this is to remind both a central law as well as a state law, Siddharth.
Absolutely, and sometimes politics at the state and central level also collide, as we have seen in several economic matters. Pre-2017, there was a lot of discussion in the rollout of GST about a revenue neutral rate. And I ask you this question in the context of your remarks on the single rate point. Today, with these kinds of collections, what do you think could be the revenue neutral rate, considering the size of the economy and how we have seen collections fare in the past several months?
I think we have already had, I don't have the exact percentages, but clearly the range is around 15.1 to 15.3%, which was the R&R that was expected. But let's not forget, today almost 70% of the products are under the 18% category and the rest at 12 or 5. Now, a revenue neutral rate in a way, in an economy of this size and scale is possible, is doable. But let's also recognize that where the 12% moves to the R&R rate, there could be a price increase. And of course, one banks on when the reduced rate comes, that benefit will get passed on to the customer, because the law does have an anti-profiteering provision that enables and takes care of potential, misuse. So I, for one, am I bullish on a R&R rate coming in soon? From a pure technical perspective, I'll be excited. But overall, on balance, I think we are a few months away, if not slightly over a few months, for a single R&R, Siddharth.
One other conceptual sort of question that was posed at the start of the GST, and I wonder whether it's valid still, which is the fact that there are several parts of our economy which are still not under the GST net, including fuel, including alcohol. Uh, does this teenager ever hope that it will be able to add on muscle in from those sectors which are currently exempted, and therefore revenues would also go up?
Yes and no. The expectation from industry is that it should happen. There have been a lot of studies that have happened around oil and gas and state excise that applies. I think one has to look at it from a state's revenue buoyancy. Let's not forget that it was July 1, 2022, 1 year ago, when the 5 year compensation that the states was getting, that sunset happened. That was the game plan all along. So there was no surprise. And the oil and gas sector has also suggested different permutation and combinations, saying that, it's not necessarily that everything comes into GST. It could be a hybrid of the GST as well as some state excise, at least to the extent where an oil and gas supply is happening to a business, that business can claim credit and things like that. But I would, for now, think maybe it's a little over a year away when these matters will get discussed on bringing in either alcohol, oil and gas, electricity, or real estate for that matter, because real estate was also very much out of the net of GST and
Absolutely.
subject to stamp duty.
Uh, how does India's GST today compare with similar sort of regimes in other economies across the world?
I think it's a double thumbs up, I would say, on the technology front, because while we are a young law, within 3 years of going live on GST, we've had e-invoicing. Other countries that have VAT systems more than 20 years are still yet to get off the ground on e-invoicing. There are different forms of e-reporting that is there, but e-invoicing in the form and shape of the clearance model that we have in India is very far away. And I, for one, have had the benefit of talking to companies and professionals in different countries, and clearly they look upon us as a case study as to how they would like to go about GST on the technology front. So technology, there's absolutely no doubt that we are way ahead. Second aspect on the legal framework as well, you started it saying it's a good and simple tax. It's also one nation, one tax. That was the message that was that was stated right in the beginning. Our survey says that that message is actually not just words, but it has happened because you have a pan-India market. 93% of participants believe that the manufacturing sector the Make in India gets a better push after GST because there's no entry tax, octroi, central sales tax, Form C, Form F, all of those things, where many of our viewers who are familiar with that regime knows how much time as well as cost was getting incurred on those aspects. So to me, I think that from a legal framework as well, there were a lot of skeptics about, oh, India has multiple states. How will you decide a place of supply? I think we've proven them wrong by having reasonably robust place of supply rules. Because when I see a lot of, from a broader lens of matters that go subject to interpretation, I think the authorities have done even well, not only on the book, but also an implementation in letting a national business operate. There are some niggles, and I think those niggles will have to be addressed. One is where you have multiple state operations. What do you do on common credits? I think that is a sore point, and we can talk about that a little later, as well as the credit getting trapped. So if we get this credit trap issue addressed, as well as some of this, moving credits from one state to another, making it a little more simple, I think we'll be even a double thumbs up, as I would say, from a law perspective. But I still think from a law perspective, we are perhaps what in different best case scenarios, different scenarios, we are in what would have been a best case scenario for a state and federal system of taxation.
Is the current regime, and I'm coming back to a point that we discussed earlier, the best case scenario as far as consumers are concerned? Because like you yourself mentioned, the treatment of many items at the 18% rate, which was the service tax rate going up, and consumers, middle class consumption getting impacted. Has GST proved to be a negative in that regard? And do you see scope for specific reforms on that front?
See, I think if you look at from a rate of tax of services, it's moved from 15 to 18. So one would say the common man has to pay more tax. But let's not forget the service provider who was not eligible to claim certain VAT credits is eligible to claim credits. And therefore, by and large, on balance, the net cost to from a service provision perspective, take a telecom service that you and I would, as a consumer, use. By and large, it's similar. But what is more critical, one may say, what is the VAT rate? Earlier, it was between 12.5 to 14.5%. The goods rate of tax has gone to 18. Is it inflationary? But we need to be understanding that what happened in GST was it subsumed both excise as well as the VAT tax. So the VAT was say 14, 14.5, and the excise was another 12.5%. So what was 27 had actually dropped to 18. So to me, from a goods perspective for a consumer, over a period of time, actually the net cost has come down on most products. I would go on a limb to say almost most, all, but let me just say most for now. On services, yes, on percentage terms, the number has certainly gone up on paper, but on balance, when you look at the net credit, it's by and large similar. But I think now when 6 years passed by, and when the consumer has got an offset of a lower rate of tax on the goods, and then with the services, to me, I have not seen GST to be coming as as an incremental cost to the pocket of the common man.
Okay, in times of high inflation, that's a very important point that you touch upon. To try and stretch the analogy that we started this conversation with further, a teenager, when he grows up, decides to settle down, marry, have a house, do all sorts of things, or the choice is really his. As a grown up, how would you expect the GST council, the father and mother of this GST, to approach the tax in, let's say, over a period of 2 to 3 to 5 years?
See, I mean, in lighter vein, handle us with kid gloves is what I would say, sticking to your analogy of this growing child. But I mean, one has to be cognizant about a very sensitive aspect that while a lot of the overall reporting is very trust-based and the whole system is very trust-based, there have been fraudulent transactions taking place. The government is on a 2-month drive to weed out fraudulent registered companies. Fake invoicing is a racket that we have seen the government do phenomenally well, and we all get to read about details of these cases. So I would say the challenge in any taxing environment in the world, if not only in India, is you generally don't make rules for only the outliers, but when you start implementing it, water will find its level. And I think that that's what is the expectation, that in the continued focus to deal with cases of potential misuse, the companies who are compliant and otherwise diligently filing returns, taking tax positions, which there could be a debate and we can agree to disagree, they should not be handled in the same way. I'm not saying it is happening carte blanche that way, but in this transformation of this age, I think industry is looking for that bifurcation of how the assessments and audits would happen, not putting it in the same, painted in the same brush. Like I said, it's some part of it is valid in terms of experience, but a lot is also an apprehension. And therefore, I'm bullish that based a lot of feedback that seems to be received around this survey, and even otherwise, the government is under a huge outreach program of taking constant feedback, both central and state governments. I think this issue will be addressed out, Siddharth. That's my assessment.
A final question and a quick one at that. In terms of reducing evasion and formalizing the economy, what do you think GST has achieved so far?
See, it's a self-policing tax, because if I, as a trader, choose not to raise an invoice for a minute, I'm going to lose my input credit. So yes, there is a loss to the extent of the last mile margin, and I'm not trying to belittle or brush that aside. But in any case, the government has a 40 lakh threshold for small traders, a 1.5 crore threshold for composition dealers. So in the larger scheme of things, the law by its sheer design was a self-policing tax, one. Two, any business that's buying a goods or a service would anyway like to have a GST invoice, because it's not a cost, it's just an asset and it goes through the books. And with all the technology, blockchain technology in the form of the e-invoicing and reporting, I, for one, think that the economy of what was potentially a parallel economy, transactions that were taking place earlier, that number would be diminishing and has diminished and will only diminish further. is my assessment, Siddharth.
Absolutely, and I think GST, along with a host of other reforms, is leading to a change in the way India conducts business. And the underpinning thought really is for the goods and services tax to continue to evolve and continue to deliver on the promise of being a good and simple tax for every taxpayer and everybody in the entire economic ecosystem. Mahesh Jaising, thank you very much for your time. With that, it's a wrap on this episode of EasyNomics, where we tried to bring you some details about GST at 6, a teenager which is on its way to growing up and becoming a full-fledged man or woman. Thank you very much for your time with us today. We'll be back with more. Till then, goodbye.
We're getting live images right now from the Delhi Metro. You can see the Prime Minister there at the metro station. He is in fact boarding that metro train and he is en route to the North Campus.